My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to make you a little money. My job's not just entertaining, but educating to teach you. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. You know it. This is a what have you done for me lately kind of market. We all know that. Sure, today was a day where we measured what the Fed's done for us lately, as Fed Chief Jay Powell spoke about interest rates, keeping them the same, talking about the need to proceed carefully. Powell's assurances that he can get inflation under control, even though it's still running a little too hot, certainly made us feel a little more sanguine about stocks. That's one reason why the Dow gained 222 points. S&P jumped 1.05%. The NASDAQ, holy cow, it pole vaulted 1.64%. But there was another reason for today's rally. It was from the Treasury Department, which published a bond issuance schedule for November. These are the bonds we need to issue to refinance our country's debt for next year. And this schedule was exactly what we needed to see because it caused long-term interest rates to fall. Put it simply, the bond market won't be overwhelmed by so-called long bonds, meaning 20 and 30-year paper. And that's another positive, something that allows Wall Street to reward good corporate news with higher stock prices.
How's pleasure?
After all, rates have gotten very tight, correct, as Powell acknowledged? So we're seeing some slowing in many areas of the economy, making earnings more perilous. Season's been tough. Of course, rates still might not be high enough. Powell said the Open Market Committee discussed more rate hikes, not standing pat. But for the moment, they left things alone. And they sound a lot less eager to tighten than they did the last meeting. You know what that means, don't you? It puts the few industrials companies that are still generating good numbers at a real premium. And it gives us the confidence to buy the stocks of companies that just reported great numbers. Buy. The problem, as I see it, is that we haven't really pointed out which companies have truly distinguished themselves during this earnings season because we've been so focused on the market's wild day-to-day gyrations. That stops right now, right here. Tonight, I'm going to tell you who did what for us lately and what happened when they did. I want to start with today's hero, or perhaps I should say heroine, and that's AMD CEO Lisa Su, who saved the day for her stock and for all of tech with one simple line in last night's conference call. Listen to this, and I quote, "Based on the rapid progress we are making with our AI roadmap execution and purchase commitments from cloud customers, we now expect data center GPU revenue to be approximately $400 million in the fourth quarter and exceed $2 billion in 2024 as revenue ramps throughout the year," end quote. Parsing that line, Dr. Su is saying that AMD's revenues from graphics processors used in the data center about to soar thanks to artificial intelligence. These are the kind of chips that people normally associate with NVIDIA, and as they come online, it's going to produce bountiful sales for AMD. I've always said that this company is the only company that has a chance of becoming a meaningful competitor in AI chips. And it's clear that business is strong enough that there's plenty of money to go around for both NVIDIA and AMD. Su's talking about real revenues this year, not some chimerical sales in 2027. It's what they've done for you lately, hence the stock's almost 10% rally today. With that one line, Lisa Su jump-started the moribund AI group, pushing up the stocks of NVIDIA, which have been trading like it was on death's door, along with Microsoft, ServiceNow, Amazon, and Adobe, the only companies that have actual acknowledged revenue from AI right now, at least so far. Hey, then there's Trane Technologies. TT, you've seen them on the show. Used to be mainly as heating, ventilation, air conditioning business, but it's now a sustainability solutions enterprise. Trane had incredibly robust bookings with organic revenue growth of 9% and earnings per share up 23% year over year. The legacy HVAC business is, and I quote, extremely strong, and applied climate technology is on fire, bolstered by government regulations. That's an always good tailwind to have. That's how the stock could jump 12% single session. Or how about Eaton? Wow, old-fashioned metal bender, huh? No, shrewd pivot. It's become the leader in a host of megatrends, including electrification, energy transition, digitalization, infrastructure spending, and reindustrialization. You know what? I'm calling that the royal flush of American business themes, and Eaton dominates them all. On the conference call, Eaton explained that it's expanding data center build-out, some of which, and I got a quote here, are being modified to support the adoption of generative AI. Holy cow! Anything that generates electricity in a relatively clean way seems to have Eaton's fingerprints on it. It's all captured by this sentence from the conference call. Another trend driving higher electric content is the need for solutions that allow bi-directional flow of power back to the grid and the ability to optimize the use of renewable energy to power data centers. Boom shakalaka. I mean, that's what we need, right? Hey, that's how stock rallies 3.3%. It's the best in show anyway. I think you'd still buy it. Those are all the saviors of the last 24 hours, and I can't say enough good things about them. You know what? They joined the likes of Linde, a growth cyclical industrial gas company, which has become one of the most reliable beat and raise enterprises in the universe, owned by the Travel Trust. Street calls Linde a, quote, sleep at night stock because of its endless margin improvement, consistent cash generation, and great cash deployment. Barclays even described it as a stock that allows you to hit, and I quote, the snooze button. Oh, I wish we had more snooze buttons. Same goes for General Electric, which last week showed that it had some of the best numbers I can recall because of a terrific aerospace business. And with, and I quote, orders up double digits with services up 15%, equipment up 22%, and growth in all segments, end quote. GE stock got dinged today because of some offshore wind project cancellations. Hey, my home state of New Jersey, not good for its coming power spinoff, but it's giving you an opportunity to buy this high-quality industrial at a much better price. Of course, as much as I salute these stocks, they've been running here, and regular viewers know that I hate to chase. So therefore, you might want to ask, who's at the cusp of a turn in business whose stock is way down, a positive turn, even as their stocks right now are shunned? Who's the next AMD? Who's the next trade? Let me tell you about two of the stocks we own from Travel Trust because they're way down, and I think they could be primed to get better. You sure ain't paying top dollar. We're going to start with DuPont. Yeah, Double D, the old-fashioned chemical company that reported what was widely panned as a disappointing quarter today. Yet, if you speak to the ever-bankable CEO, Ed Breen, he said that he's finally seeing some green shoots in the electronics end markets that are a major driver of DuPont's earnings. Normally, I'd say that you can just forget about this one, another screwed-up one. But Ed told me that he suspects a turn could be at hand. And Ed's been, he's been around the block. I trust him. I trust DuPont. I could be wrong. I'm wrong about stocks. I know that. But I like this one. Second, there's a stock that the trust bought today, and boy, is it ever down. And now it's called Oracle. And it certainly fits the AMD pattern. If you recall, when Oracle reported, CEO Safra Catz and founder Larry Ellison talked about how their data center cloud AI business is on fire. Well, I can buy into that down here. The stock's 22 points from its high, 19 times earnings. Not too shabby, not too risky. Now, remember, this exercise of rewarding the companies that beat the numbers has only been working inconsistently of late because we've been so darn worried about interest rates. When long rates soar, nobody cares about the earnings I just mentioned. But we had no worries today because the Fed just spoke and Treasury rolled out a jolly benign bond issuance schedule. More on that in a moment. Bottom line, these two positives make the what have you done for me lately equation a game worth playing. Because suddenly the market actually cares about the results of individual companies. Given that the Fed and Treasury won't be able to do a 180 anytime soon, and we still have an oversold market, we could have more moments just like this one. Hey, why don't we go to Lane in New York? Lane.
The doctor of gymology. What's going on, Jimmy Baby?
No, it's my wife's birthday, just trying to have some fun. What's going on with you?
Hey, I want to tell you, you are the Ted Williams of the stock gurus.
401? I hit 401. Maybe not bad. I can see the ball better than anybody. 370 after he came back from 3 years in the war. Now, that's a guy that I like. What's going on?
All right, hey, I got Tractor Supply. Do you think I should put more invested in it? Get rid of it?
I don't like the retailers. Lean. I'm a Costco guy. I'm a Walmart guy. I'm an Amazon guy. And I'm a TJX guy. And never the twain shall meet. Let's go to Brian in Florida. Brian.
How are you doing, sir?
Brian, I'm doing real well. How about you? What's going on?
I'm doing well, thank you. I just want you to know I have tremendous respect for your expertise and your insight in the stock market. I wanted to get your perspective on FedEx. Could you share your insights?
I'll give you my perspective on FedEx. It is run by one dynamite CEO. I think the world of this company, Raj Subramanian, is going to be able to handle this downturn at $243. I'm saying it is a buy. Travis in Kansas. Kansas City. That's Travis Kelce, right? Tell him I want to just put the girlfriend on. Hey, how you doing?
Let's hear about.
Is this Mr. Pfizer?
The Netflix.
I thought it was Mr. Pfizer. All right, now which one? Which stock?
Netflix movies.
I like Netflix. They just wore a dynamite quarter. They got good ad-driven stuff coming. I think that it is high quality. And by the way, just so we know, it kind of already had the dip. And now it's got the pause and refresh. You can buy Netflix. We're going to go to Will in Kentucky. Will.
Hey, Jim, this is Will in Lexington. Hey, I had a question about Palo Alto Networks. I'll be honest, I've kind of trimmed a lot of my individual positions Of course, I still got some ETFs, but I like Palo Alto because it's got cash flow, and I like the story. I mean, it doesn't seem like we're going to be in a safer world.
All right, listen to me, Will. Will from Lexington. I happen to like the town of Lexington very much. I've been to that horse park there. It's dynamite. Here's what I know about Palo Alto. I'm calling it best in show when it comes to cyber. The fact that it's at 244, still down, it's down 21 points from its high. You're dealing with Nikesh Arora. Whenever you hear about these cyber attacks, whenever you hear about what North Korea's up to or what Iran, you should be thinking, I got to buy some. P-A-N-W. And that's why Will has horse sense. Given that the Fed and the Treasury won't do 180 anytime soon, since they just spoke today, we still have an oversold market. We can have more moments like today. I think this was a bona fide good one. Mad Money tonight. On this all-important Fed decision day, I'm thinking about the man I call the savior of the bond market. Not familiar? Josh Frost. Write that down. And what today's investors can learn from his approach to yields. Then, could Kava be the next Panera? Or is the harissa chicken too spicy to touch right now? I need it, but I always like to have a side of Pepto. You know, Pepto's good for me. I'm taking a look at this fast casual stock ahead of its report next week, and I want to get a closer look at consumer spending habits. So who better to talk about that? And how about the company that owns Chili's and Maggiano's? Don't miss my exclusive with the CEO of Brinker, symbol EAT, after the company's impressive report this morning. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.